On a Sunday afternoon in September 1985, five men in dark suits gathered in a private suite at the Plaza Hotel in New York and agreed, in the space of a few hours, to cut the value of the US dollar in half. James Baker was there for the United States, Noboru Takeshita for Japan, Gerhard Stoltenberg for West Germany, Pierre Bérégovoy for France, Nigel Lawson for the United Kingdom. There was no press, no leaks, no congressional debate. By the time the sun set over Central Park, the yen was on a trajectory that would take it from 240 to the dollar to 120 to the dollar in less than 3 years, and a decision had been made that would inflate the largest asset bubble in the history of the modern world, hollow out an entire generation of Japanese savings, and lock the world's second-largest economy into a stagnation that hasn't fully ended 40 years later. The story you've probably heard about that afternoon is a very tidy one. 5 finance ministers, 1 hotel, 1 handshake. A coordinated intervention to rebalance global trade. The dollar had gotten too strong. American exports were suffering. The Japanese were selling too many cars and cameras, so the grown-ups of the world sat down together and gently corrected the imbalance. It's a clean story. It's a simple story. And it's mostly wrong. Not because the parts are fabricated, but because of what the stitching leaves out. What the polite version leaves out is that at least one man in that room understood, or had every reason to understand, that forcing the yen to double in value against the dollar would not simply cool Japanese exports. It would compel the Bank of Japan to flood its own financial system with the cheapest credit in the country's post-war history, and it would do so under sustained pressure from the US Treasury not to stop. The question this whole story turns on is whether the architects of the Plaza Accord knew what they were about to detonate inside Japan, or whether they simply chose not to know. To sit in that suite, you have to understand what the dollar had been doing for the 5 years before it. Between 1980 and 1985, the US dollar had risen roughly 50% against the currencies of America's major trading partners. Paul Volcker had crushed inflation at the Federal Reserve with interest rates that peaked near 20%, and the world's capital had come flooding into dollar assets to earn those yields. That was good for anyone holding dollars. It was catastrophic for anyone trying to sell American goods abroad, and it was a windfall for anyone selling foreign goods into the United States. American factories in the Midwest were closing. Steel towns were emptying. Ohio, Pennsylvania, Michigan, and in Washington, the pressure on the Reagan administration to do something about the Japan problem had reached a level that career Treasury officials still describe, in interviews given decades later, as unbearable. James Baker had come over from the White House to run the Treasury in early 1985, replacing Donald Reagan in a swap that reshuffled the 2 most powerful economic offices in the administration. Baker was not an economist. He was a Texas lawyer and a political operator of exceptional skill, and he brought with him the instinct of a political operator, which is that a visible problem requires a visible solution, delivered quickly, on terms you control. The dollar was the visible problem. And Baker decided over the summer of 1985 that the solution was not to let the market grind the dollar down on its own timetable, but to gather the other major economies and push it down together, hard and fast, in a coordinated intervention that no single speculator could stand against. Here's where the standard telling starts to fall apart. When you read the memoirs and the later accounts, when you look at what Takeshita himself said afterwards, you find that the Japanese finance minister came to the plaza willing to accept a yen appreciation of maybe 10 to 12%. That was the number he'd carried in his briefcase. That was what his ministry had modeled. A modest, manageable adjustment, and the Plaza communique, when you read it carefully, doesn't actually specify a target. It talks about orderly appreciation of the non-dollar currencies. It's vague on purpose. But the moment the markets read that communique, the moment the traders in London and Tokyo and New York understood that the 5 biggest economies in the world had just committed to selling dollars in unison, the vagueness became irrelevant. The yen didn't move 10%. It moved 10% in the first week. By the end of 1985, only 3 months after the accord, the yen had blown through 200 to the dollar. By the summer of 1986, it was near 160. By early 1988, it touched 120. The The currency had, in effect, doubled. Now, imagine what that does to a Japanese exporter. You're a mid-sized company in Nagoya making auto parts. Your entire cost base, your wages, your rent, your raw materials, everything is denominated in yen. But you sell into the United States and you invoice in dollars, and the dollars you take in are now worth half as many yen as they were 2 years ago. Your margins don't shrink. They vanish. Whole product lines that were profitable in 1985 are underwater by 1987. Multiply that Nagoya parts maker by every export-facing manufacturer in Japan, from the largest automaker down to the family firm, stamping out kitchen sinks in Osaka, and you understand why the Ministry of Finance in Tokyo began almost immediately to panic. And here is the part of the room dynamic that the tidy version never quite explains. Why did Takeshita agree to any of this at all? Why did the Japanese delegation, knowing what a doubling yen would do to the country's export machine, sit at that table and sign? The answer isn't in the communiqué. The answer lives in the geometry of the room itself. Japan in 1985 was an economic giant and a security dependent. Its home islands were defended, in the last analysis, by American bases, American aircraft, an American nuclear umbrella that made the entire post-war Japanese prosperity possible. Nobody at the plaza said, out loud, that the security relationship was on the table. Nobody had to. Everyone understood that the United States was, in the mid-1980s, engaged in a series of trade fights with Tokyo that were producing genuine anger in Congress, real proposals for tariffs, real bills with names attached. When James Baker asked Noboru Takeshita to accept a yen appreciation, he was not asking as a peer. He was asking as the treasurer of the country that guaranteed Japan's existence. This is the asymmetry the tidy account skips past in one sentence, if it mentions it at all. The Plaza plan itself was held on a strict need-to-know basis. Within the U.S. Treasury, within the Japanese Ministry of Finance, within the Bundesbank and the Banque de France and the British Treasury, only a small circle of officials knew what was being negotiated in the weeks before September 22nd. The G5 finance ministries and their central banks operated the whole thing on secrecy so rigorous that even senior staff in the same buildings were kept out of the loop. And this matters, because it means that the decision to reshape the value of the world's second most important currency was made by, at most, a few dozen people. It was not deliberated in any parliament. It was not put to any vote. It was executed by memorandum, over a weekend, in a hotel. What did Takeshita think he was signing? By his own later account, and by the reconstructions historians have done from Japanese Ministry of Finance documents, he believed he was agreeing to a bounded adjustment, a managed nudge. He'd been told the intervention would be calibrated, that it could be stopped once the target was reached. In the event, the target of a 10 to 12% dollar depreciation was hit with less intervention than anyone had expected, because once the markets understood the commitment, the markets did the work themselves. And this is where the mechanism turned on its architects. There was no break. Once the yen was moving, once the speculators were positioned, once the trend was in place, the Bank of Japan and the U.S. Treasury could not simply announce that the appreciation had gone far enough and reverse it. The currency kept climbing, past 200, past 180, past 160. And every 10 yen it climbed, another layer of Japanese industrial capacity became unprofitable at world prices, so the door had closed. Japan was inside a room with a currency roughly twice as strong as it had been when the year began, an export sector in acute distress, and a political commitment made at Plaza and reinforced 15 months later at the Louvre Accord in Paris to stimulate domestic demand as a way of soaking up the slack. That commitment was the polite formulation of a very specific instruction. The instruction was, cut interest rates and keep cutting until the Japanese consumer and the Japanese investor make up for the exports you can no longer sell. And this is where the man in the room, whose name almost nobody remembers, the governor of the Bank of Japan, walks onto the stage. His name was Satoshi Sumita. He was not a monetary economist. He was a career bureaucrat from the Ministry of Finance who had been placed at the head of the Bank of Japan the previous year, and he was widely understood inside Tokyo as a placeholder. Someone who would do what the ministry told him to do, which was exactly the man the moment required, from the ministry's point of view, because the ministry had just been handed an impossible task and needed a central bank governor who would not push back. On January 30th, 1986, roughly 4 months after Plaza, Sumita cut the official discount rate from 5.0% to 4.5%. In March, he cut it again to 4.0. In April, to 3.5. By November, to 3.0. And on February 23, 1987, in the fifth cut in just over a year, he took it to 2.5%. That was the lowest official discount rate in the history of post-war Japan, and he held it there for the next 27 months. 27 months. Think about what that number means. By the middle of 1987, the Japanese economy was growing at better than 4% a year. The immediate crisis of the yen shock had passed. The exporters had begun to adjust, cutting costs, moving production offshore, redesigning products for a stronger currency. By any conventional reading of monetary policy, the emergency rate should have started coming back up in 1987. Instead, it stayed at 2.5% through all of 1987, all of 1988, and into the spring of 1989. 2.5 years of the loosest money in modern Japanese history, applied to an economy that no longer needed loose money at all. The rate wasn't lifted until May of 1989, by which time the Nikkei had roughly tripled, land prices in central Tokyo had gone somewhere close to vertical, and the machine was, by any honest reckoning, out of control. Why? Why did Sumita hold the rate down for 2 full years past the point where the fundamentals justified it? The polite answer is that Japan had committed, under the Louvre Accord of February 1987, to stimulate domestic demand. The Louvre communiqué had asked the surplus countries to keep their monetary conditions supportive of growth, and Japan, dutiful ally, was doing what it had agreed to do. The impolite answer, the one you find when you look at the internal dynamics of the Bank of Japan in this period, is that Sumita had no independent authority to defy either the Ministry of Finance in Tokyo or the U.S. Treasury in Washington, both of which wanted the rate held down. James Baker, throughout 1987 and 1988, made it publicly clear that the United States expected Japan to keep stimulating. Any signal from the Bank of Japan that it was preparing to tighten would have been read in Washington as a violation of the Louvre commitment and treated accordingly, so Sumita didn't signal. Sumita held, and the money, meanwhile, went somewhere. The simple version of what happens when you cut interest rates that low for that long is that cheap money flows to borrowers, and borrowers spend it. That's the textbook. The real version, in Japan in the second half of the 1980s, is stranger and worse. Under the Ministry of Finance's regulatory system, no Japanese bank was permitted to fail. This was the famous convoy system, Goso Sendan Hoshiki, in which the slowest ship set the pace, and the ministry ensured that every institution stayed in formation. If a bank got into trouble, the ministry would arrange a rescue, a merger, a quiet transfusion from a stronger neighbor. Depositors would never lose a yen. This was celebrated at the time as the secret of Japanese financial stability, and it worked in its way for decades. But it had a consequence that only became visible once the discount rate hit 2.5%. If no bank can fail, then no loan officer has to price risk honestly. The price signal that, in a market system, tells a lender to charge more for a shakier borrower doesn't function. Every loan is, in effect, guaranteed by the ministry, and so the city banks, Daiichi Kengyo and Sumitomo and Fuji and the rest, began to lend on terms that no functioning credit system would have accepted, because the discipline that would have stopped them wasn't there. They lent, above all, against land. Japanese real estate had risen more or less continuously for the entire post-war period. Land in Japan, went the saying, does not fall in value. It was the safest collateral a bank could hold, and every loan officer knew it. So when a customer walked in wanting to borrow against a plot of Tokyo real estate, the loan got made, and the size of the loan got sized to the value of the land, and the value of the land was determined by what similar plots had recently sold for, and what similar plots had recently sold for was determined, increasingly, by what other banks had recently lent against them. The loan created the price. The price justified the loan. And in a system where the central bank was pumping in liquidity at 2.5%, the cycle could not do anything but accelerate. The Nikkei tells the story in numbers. In late 1985, when Plaza was signed, the index stood near 13,000. By the end of 1986, after a year of Sumita's rate cuts, it had climbed past 18,000. By the end of 1987, despite the global shock of Black Monday in October, when the Dow lost more than 22% in a single session, the Nikkei recovered within weeks and closed the year near 22,000. Western markets bled for months. Tokyo shrugged and kept climbing. And this uncanny resilience, was read at the time not as a warning sign, but as proof of Japanese economic superiority. The country had a system, the analysts said, that Wall Street could only envy. A patient, long-horizon, coordinated approach to capital allocation that made American short-termism look primitive. Books were written. Business school curricula were rewritten. The 21st century, everyone agreed, was going to be Japanese. And somewhere in a mid-sized construction company in Osaka, a section chief was looking at the appraised value of the land the firm had bought a decade earlier for its equipment yard, and he was realizing that on paper, that single parcel was now worth more than every yen of revenue his company had ever earned. He hadn't done anything. He hadn't built anything new. He just held the dirt. And the dirt, according to the appraiser and the bank and the market, had become more valuable than the entire operating history of the firm. He wasn't alone. He was, by 1988, the entire country. The numbers that came out of 1989 still don't quite fit inside ordinary language. Not because they're hard to understand, but because understanding them requires holding two things in your head at once, that they were real and that they could not last. The Nikkei closed 1989 at 38,915. That's the number most people remember, but it's the land figures that carry the real vertigo. By the peak, a single square meter of prime retail space in the Ginza, Tokyo's high-end shopping district, was fetching the equivalent of more than $236,000. Not for a building, for the ground beneath it. 1 square meter of Tokyo dirt. And in the center of the city, the 1.15 million square meters occupied by the Imperial Palace grounds, a patch of land that no one could build on, that produced nothing, that existed purely as a ceremonial space, was theoretically valued at more than all the real estate in the state of California. California, with its cities and its ports and its farmland, and its tens of millions of privately held acres. One moat-ringed park in central Tokyo, on paper, worth more than all of it. These numbers didn't arrive from nowhere. They were the product of a specific sequence of decisions made in specific offices and boardrooms and bank lending committees, and if you trace any of them backward, everyone leads to the same machine. Nomura Securities, by 1989, was the largest brokerage in the world by market capitalization, worth more than any American investment bank, worth more than Merrill Lynch and Goldman Sachs combined. Nomura and the other major brokerages, Daiwa and Nikko and Yamaichi, operated in a market where institutional investors were effectively guaranteed returns. The practice of compensating major clients for trading losses was an open secret. It meant that the normal mechanism that disciplines speculation, the possibility of actually losing money, had been muted for the participants large enough to move markets. Pension funds and corporate treasuries poured into equities because they were, in the ways that mattered to an institutional buyer, not really at risk, and the city banks kept lending against the rising collateral values, because the collateral kept rising, because the banks kept lending. It's worth pausing on what bubble actually means in this context, because the word has become so routine it's lost its strangeness. A bubble isn't just prices going up fast, it's prices going up because people believe they'll keep going up, in a loop that's disconnected from any underlying reality, sustained entirely by momentum and confidence, and the institutional arrangements that allow the confidence to persist. The Imperial Palace valuation wasn't a number that reflected what anyone could realistically extract from that land. It was a number produced by a formula. Take what similar assets recently sold for, apply the current lending multiples, and report the result as a market price. The formula worked so long as everyone agreed to use it. In 1989, everyone still agreed. But not everyone was comfortable with the agreement. Yasushi Mieno became governor of the Bank of Japan in December 1989, and he was not Satoshi Sumita. Where Sumita had come from the Ministry of Finance, was understood as a ministry man, had held rates at 2.5% through 27 months of an accelerating asset boom. Mieno was a career Bank of Japan official. He'd watched the bubble inflate from inside the institution that had inflated it, and he'd formed a view. The view was that what was happening to Japan wasn't prosperity, it was a moral catastrophe. The distribution of wealth being produced by rising land prices, in which those who happened to hold land before the boom became paper aristocrats, and those who didn't found home ownership effectively beyond reach, was an affront to the social contract the post-war economy had been built on. Young workers in Tokyo were spending more than half their take-home pay on rent, and still moving further from the city to find it. The country was getting richer on paper and less livable in practice, and Mieno had concluded those two things were connected. The Bank of Japan had actually started moving before he took over. The discount rate had been raised for the first time in May 1989, the first increase since the Plaza cuts began, and it was raised again as the year progressed. But Mieno accelerated the program. Between December 1989 and August 1990, he raised rates 5 times. By August, the discount rate stood at 6%, up from the 2.5 that had fed 4 years of frenzy. This is the moment to stay with, not because it's dramatic in the conventional sense, but because of what it actually was. Internal Bank of Japan documentation, and Mieno's own subsequent testimony, make clear that these hikes were not a miscalculation. They weren't a well-intentioned policy that turned out to be too aggressive, a case of good people overshooting. The bank understood that the asset values were unsustainable. It understood that unwinding them would cause pain, and it raised rates anyway because the governors had concluded that sustaining the bubble was the worse option. That the social damage of allowing land prices to continue rising, pricing an entire generation out of ownership, out of ordinary family life, out of the economy the country was supposed to be building for them, outweighed the disruption of ending it. So they pressed the detonator consciously and deliberately, with full knowledge of what was coming. The Nikkei peaked on December 29, 1989, at 38,915.87. By the end of 1990, it had fallen by nearly a third. Tokyo real estate prices began their formal collapse in late 1991, and somewhere in the files of the Bank of Japan was the documentation that said, "We knew. We chose this." That answers the question this story has been circling since Plaza. Why did no one stop the bubble on the way up? The answer is that the institution best positioned to stop it was, under Sumita, a captured institution. Its governor owed his appointment to the ministry. Its policy was set in accommodation of ministry preferences. The independence that would have allowed it to act in 1987, when the asset markets first started showing the signs of disconnection, simply didn't exist. And by the time Mieno arrived, and that independence reasserted itself, the bubble was already 3 years old and 3 years deep. But this answer opens the next question immediately, because if the crash was a policy choice, if Mieno's tightening was a decision made by people who understood what they were doing, then what followed was also a policy choice. At every point in the decade that came after, someone had the option to do something different, and mostly they didn't. The phrase that got attached to the 1990s in Japan was the lost decade. By the time the decade ended, and the stagnation hadn't, it became 2. By the time the generation that graduated into it had spent their working lives inside it, it had quietly become 3. Lost suggests accident. It suggests that something was mislaid, misread, that the people in charge were doing their best, and circumstances defeated them. The record doesn't support that reading. By 1991 and 1992, Japanese banks were sitting on enormous quantities of loans that weren't being repaid. Borrowers who'd taken money at the peak of land prices now held collateral worth a fraction of what they'd paid, in some cases less than the outstanding loan balance. Under honest accounting, a significant portion of the Japanese banking system was insolvent. The Ministry of Finance knew this. It had the numbers, and it made a choice. The choice was forbearance. From roughly 1992 through 1998, the ministry allowed banks to carry non-performing loans on their books at face value rather than marking them to what they were actually worth. The plain language version of that policy is, the government let the banks pretend they weren't broken. No bank would be forced to write down the bad loans, and no bank would fail. Because if the banks admitted their true condition, the ministry would have to admit that the entire system it had guaranteed and presided over and celebrated as the envy of the world had collapsed. And that was a price the ministry wasn't willing to pay. The consequence was zombification. Banks that were quietly insolvent couldn't lend productively because every yen of available capital was being used to roll over loans to companies that couldn't pay them back, so that neither side had to acknowledge the reality. Construction firms that should have gone bankrupt in 1993 were still operating in 1998, not because they were competitive, but because their creditor banks couldn't afford to let them fail. And the political economy of the Liberal Democratic Party, which had governed Japan for all but a handful of months since 1955, was deeply intertwined with exactly this sector. Construction employment grew from 5.3 million workers in 1985 to 6.85 million by 1997. These were voters, and they were constituents, and the companies paying their wages were the zombie borrowers the banks were keeping alive on rolled-over credit and regulatory indulgence. In the ministry's ledgers and the party's donor networks, the stagnation had a constituency. Richard Koo watched all of this from his desk at Nomura Research Institute and developed a framework he called the balance sheet recession. The concept is straightforward once you see it. In a normal recession, low interest rates and fiscal stimulus work because the problem is a shortfall in demand that more money can fill. But when the private sector is sitting on enormous debts, when every household and every company and every bank is working to pay down borrowings rather than take on new ones, interest rates stop mattering. You can lower the cost of borrowing to nearly zero, and the private sector still won't borrow more, because what it needs to do isn't spend, it's repair. In a balance sheet recession, direct government spending into the economy is the only thing that can hold up demand while the private sector deleverages. But it has to be sustained, and it absolutely cannot be reversed too soon. Japan tried fiscal stimulus in fits and starts, and it helped in fits and starts. Each time a recovery started to take hold, the Ministry of Finance, spooked by the accumulating public debt, tightened prematurely. In 1997, with growth finally returning and the economy looking like it might actually find its footing, Finance Minister Ryutaro Hashimoto raised the consumption tax from 3 to 5%. The economy went back into contraction within months. Koo's framework predicted exactly this outcome. The IMF and the World Bank sent recommendations. The documents were received, translated by ministry staff, circulated to the relevant desks, and not acted upon. Because acting on them would have required admitting, publicly and formally, what the forbearance policy had been protecting everyone from having to admit, that the system had failed, that the choices made between 1985 and 1990 had been catastrophic, that the losses were real, that they needed to be recognized and absorbed, and that the sooner that happened, the sooner the economy could move. The ministry couldn't say that. Saying it would be to indict itself. So it didn't say it, and it didn't act, and another year became another year, and another year became a decade, and the decade became the permanent condition. Somewhere in Osaka, that same section chief from 1988, the one who'd looked at the appraised value of his company's equipment yard and realized the dirt was worth more than everything his firm had ever earned, was probably still working there in 1997. The company was probably still alive, technically, still being rolled over by its bank, which was itself still alive, technically. The land was now worth a fraction of what the appraisers had said, but the loan taken against that inflated valuation was still on the books somewhere, still part of the invisible mountain of bad debt that the financial system was collectively pretending wasn't there. He was 52 years old, and the economy around him had stopped. He hadn't made bad decisions. He hadn't been reckless. He'd just been standing in the wrong place when the choices made by other people, in other rooms, came due. He wasn't a failure. He was a policy outcome. Now, let's go back to the question this documentary opened with. 5 finance ministers sat in a room in New York in 1985 and set something in motion, but Plaza didn't cause the lost decades. It was the first choice in a chain of choices, and every link in that chain was made by people who could have chosen differently. Sumida could have raised rates in 1987 when the asset markets first showed the signs of disconnection. The city banks could have priced credit honestly rather than sheltering behind the convoy system's implicit guarantee. Miyano arrived too late, but at least he arrived, and at least he was honest about what he was doing. The ministry could have forced the banks to recognize their losses in 1992, taken the acute pain of a genuine restructuring, and spared the decade that followed. Hashimoto could have held the consumption tax in 1997 and let the recovery consolidate. At each of these forks, there was a shorter and harder road that led somewhere real. The people with the authority to take it chose not to. What happened to Japan after 1990 wasn't the inevitable hangover of an inevitable bubble. It was a generation's economic life, paid as the price of bureaucratic self-protection, institutional face-saving, and the political convenience of leaving the reckoning to someone else. The architecture behind that sentence didn't stay in Tokyo. The use of monetary policy to defer structural problems rather than solve them, the decision to let insolvent institutions carry losses they'll never formally acknowledge, the bureaucratic reflex to postpone the honest accounting until postponement itself becomes the permanent condition. These became the operating assumptions of every major financial system that followed. Japan didn't just experience the playbook, Japan wrote it. The 1997 Asian financial crisis is exactly the next link in the same chain, the same mechanisms moving through different countries, the same choices dressed in different currencies. That's the next video. If this one was useful, the like and the subscribe help more people find it. We'll see you there.